In our previous briefings, we mapped the physical footprint of artificial intelligence. We looked at the dirt, the water, the grid, and the geopolitical battle for sovereign control. We established that AI is not a digital phenomenon. It is a heavy industrial reality. But there is a fatal flaw in how most people and most corporations think about sustainability. They reduce it to carbon. They reduce it to megawatts and water usage. If you look at the board the way the players do, you understand that true sustainability is a three-legged stool: environmental, governance, and social. And right now, the AI revolution is fracturing the social leg of that stool. We are witnessing the greatest reallocation of wealth and human capital in modern history. The productivity gains of AI are staggering, but they are not being distributed evenly. They are flowing directly to the owners of the capital, while the human cost is being externalized. Today, we are going to look at the final, most volatile layer of the AI sustainability system. We are going to look at the new wealth concentration, the hollowing out of the white-collar workforce, and the coming corporate accountability reckoning. If you want to understand where the real risks lie in the AI economy, you have to look past the data centers and look at the people. Let's start with the economics of productivity. For the last century, technological advancements generally lifted the broader economy. A rising tide lifted all boats, creating new industries and expanding the middle class. AI is different. AI is what economists call a capital-biased technology. It replaces human tax-paying workers with algorithms owned by corporations. Look at the data from 2025 and 2026. Global billionaire wealth jumped by over 16% in a single year, reaching the highest level in human history. A massive portion of that $2.2 trillion gain was driven directly by AI-related tech stocks. We saw nearly 50 new billionaires minted solely from the AI boom. But what happens to the workforce? The narrative has always been that AI will create more jobs than it destroys, but the reality on the ground is shifting. AI is not just automating physical labor, it is gutting the entry-level white-collar workforce. It is automating administrative, clerical, and routine cognitive tasks. These tasks traditionally served as the stepping stones to the middle class. When a company deploys AI that does the work of 50 junior analysts, productivity skyrockets. But those gains do not go into higher wages for the remaining workers. They flow directly to the shareholders as dividends and stock buybacks. This is the great divergence. We are moving toward a winner-take-all economy where the owners of the foundational models capture almost all economic value. From a social sustainability perspective, this is a powder keg. When wealth concentrates at the very top, political instability inevitably follows. The smart money is already stress-testing their portfolios for the regulatory backlash that will come when governments realize their tax bases are eroding. This brings us to the second reckoning, the corporate governance crisis. Institutional investors poured trillions into ESG funds that prioritize social and governance metrics. But AI has shattered that illusion. Investors are waking up to the fact that big tech's climate pledges are colliding with their AI ambitions. When a company claims to be net zero, but their emissions are surging by 30% due to data center expansion, the market notices. We are now seeing a wave of what is being called AI washing litigation. Companies are facing lawsuits for misleading the public about their AI environmental cost. Institutional investors are demanding transparency. They are no longer accepting vague promises. They want to know if a climate pathway is credible under high-growth AI scenarios. Furthermore, the implementation of the EU AI Act in 2026 is forcing companies to legally classify the risk of their AI systems. Fines are massive. The era of moving fast and breaking things is over. The era of compliance, auditability, and legal liability has begun. Laggards will face crippling litigation. So, where is the durable value in this volatile system? The institutions that understand social sustainability are adopting what we call the hybrid model. They use AI to automate the routine, but they aggressively reinvest those productivity gains into reskilling their human workforce for complex relational roles. They understand that while AI can optimize a supply chain, it cannot build trust, negotiate a complex deal, or navigate a political crisis. They know that a company with a hollowed-out workforce and a massive carbon footprint is fundamentally fragile. It is vulnerable to strikes and public backlash. The true winners of the AI revolution will be the entities that balance the incredible power of the algorithm with the resilience of human capital. We have spent 4 episodes breaking down the AI sustainability system. We looked at power, water, sovereign infrastructure, and hardware supply chains. If you take one thing away, it should be this: AI is the most powerful tool humanity has ever built, but it is bound by the laws of physics, economics, and human nature. You cannot separate the digital from the physical. To navigate the next decade, you must see the whole board, focus on durability, and true holistic sustainability. If you found this series valuable, subscribe to our channel. We will continue to break down the mental models that govern global capital. Thank you for watching.